Hi, welcome to the second video on analysing stocks. Today we're going to be talking about dividend yield. The first thing we'll talk about is how to calculate dividend yield, and the second thing is what does it actually tell you, and finally how can you use it as an investor. So starting with how you calculate it. This formula here might be familiar if you've watched an earlier video on dividends, and tells you that the way to calculate this dividend yield, also synonymous with a return, dividend return, is the dividends per share. That's how much you get as a shareholder for each share you buy in cash from the company over a 12-month period, divided by the share price. So let's see an example of that. AkzoNobel is a Dutch specialty chemicals company, and they, in the last 12 months, paid a dividend to each shareholder of €1.90 per share. So if you owned one share, you received €1.90 in cash. And the share price at the moment is €79.56. So that is producing a yield of 2.4%. So assuming they pay that same level of dividend next year and the year on and the year on, you'll have a yield of 2.4%. That will be your return from paying €79.56 for a share. You get €1.90 back forever. Essentially, that's what this yield is showing you. It's kind of like an interest rate. So the question is, how can you use it? And there's some important considerations. The first thing is, has the company consistently paid dividends? Because if it's a yield that you expect to be ongoing, then the idea is that that will continue into the future. Then the next thing is, has it increased the dividends over time? And you might then expect your yield at this price to increase if they then pay more dividends. And is that business likely to continue growing? Then, back to an example that we just used is AkzoNobel. And you can see, in answer to those questions, they have increased their dividend, and they've been very consistent with paying it. They paid, in 2014, €1.45, and you can see they pay an interim dividend, which is in the half year, and a final dividend in the end of the year, December 31, and sometimes they pay a special dividend if they sell a business, say, or something special comes in, and you saw that in 2017. And so on the whole, there's an upward trajectory. It's increased by 30% in 5 years, from 145 to 190. So let's assume that they continue that growth. How's that going to affect your yield? So at the moment, we saw that the yield is 2.4%. That's the last 12 months of dividends of 190 divided by the current price, 79.56 per share. So assume another 30% growth in the next 5 years. So then they'd be paying out €2.47 per share in dividends. Divide that by the current share price, because that's how much you have to pay now. Now your yield has actually gone up to 3.1% because you bought it up now. And you'd assume that the share price in the future will go up to reflect that, so that the yield actually stays for the people buying it in the future at around 2.4%. So that's the advantage of buying now. Your yield can actually go up if they pay more dividends. So it's important to remember that this dividend yield, the 2.4% or whatever it turns into 3%, is in addition to any increase in the share price. That you have both returns. And as I explained, the dividend yield is a bit like an interest rate. It's just this return you get on your money, and you get the actual income from your assets. You get the income from the shares, and you can use the cash if you want to. So it can be a useful investing tool for that thing if you want income, as opposed to just the growth of the share price. But if you don't want the income, you can also automatically reinvest your dividends and buy more shares. The company will do that automatically for you, so you don't receive the cash and you receive just more dividends. So that completes our video on dividends, and I look forward to seeing you in the next one.